Welcome to section 13.5. This section is about investments and specifically in the stock market. And so they're just wanting us to be familiar a little bit with the investments and the terms that they use, just to be a little bit more informed in what we do. And so I think the questions in here are going to be pretty straightforward, but I'm hoping to connect to each one of the homework problems that you're going to do through this video. When you sit down to the first four homework questions, they're going to ask you about some definitions. And so, again, we're dealing with working in the stock market. So, if we look at stocks in general, there are some things in which you can make money in stocks. The first way is the way that you know, and that is to sell it for more than you buy it. That's the ideal. Because if you sell it for more than you bought it for, then you make a profit. Now that doesn't always work, right? You see these big dips in the market. That's some people taking losses right there and getting rid of things at lower prices. And so you could have a gain or a loss. That gain has a very specific term. The capital, sorry, I don't know why I made it look like a G. Oh, I know why, because I said capital gains. So it's called a capital gains. So if you ever hear of a capital gains tax, that is tax specifically on stock investments. And so there's different tax rates for capital gains depending upon your income bracket and other things like that. But capital gains is the amount you gained or earned on a stock. Now, they could be negative. So they'll call it capital gains no matter what, but it is also possible that you lost money, right? That you lost on a stock. And so you'd enter in a negative capital gains or state that you have a negative capital gains. So they'll probably ask about that. The other way that you can make money on stocks is through what's called dividends. So a lot of big companies like Apple and others, they pay their stockholders some amount every year or every quarter, depends, for holding their stock. And so the dividends is basically money given to a shareholder just for having the stock. So I could buy 100 shares of Apple and never buy it, or I'm sorry, never sell it or buy more, and they'll pay me a dividend based upon me having 100 shares, and it's some amount of money per share, and those are usually listed in stock charts, and we'll see that a little bit later. But that's the two ways that you can make money holding stocks. The stocks are usually held on what they call stock exchanges. So that is where we're able to buy and sell stocks. And there's a few major ones. The ones that I can think of right now are the New York Stock Exchange and then the NASDAQ. The NASDAQ has a lot of tech companies. Forgot the A part of it. I'm not quite sure what it all stands for, what the acronym stands for, but it definitely stands for something. But the NASDAQ has the tech stocks. The New York Stock Exchange has the stocks that we're more used to, the big companies there, pharmaceutical companies, oil companies, and other companies like Facebook and Snapchat that went public. And then the last thing that I heard them talk about is what's called a mutual fund. And again, all these definitions will be asked for right in the beginning, at least an understanding of them. A mutual fund is a collection of stocks and often bonds. Now, what a bond is, it's usually just something that you buy a bond and it's going to give you a guaranteed interest rate, but you have to keep it a certain amount of years. So it's called the maturity date. So while we're talking about it, a bond is basically a certificate that you buy that pays a guaranteed interest. So you think, well, why wouldn't I take the guaranteed interest? Well, it's pretty low. Typically, so the bond market, bonds right now are maybe 1%, 2% bonds if you keep it for 7 years. So you're going to make 2% as an annual percentage rate over the next 7 years. But if we look at the past 7 years, you would have done much, 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 much better putting your money in the stock market, even with the falls that have happened because of the gains that were there. You would have earned more than that 2%. But there's times where in that 7 year period, things really fall apart and it's better to have the bonds. So bonds are considered more stable because it's guaranteed. And so it's a mixture of stocks and bonds, risky stocks sometimes, and bonds to balance it out. But it's managed by somebody. And so they pick different funds and sell at different times. But that's what a mutual fund is. It's just a collection of things to have you more diversified. So let's look at the first example that you're going to be given. This would be example 1 is reading a stock table. That's actually going on for 7 questions. Questions 5 through 12 are all dealing with reading a stock table and various information from it. And so they'll give you different tables. This is an example of one. If we go and look at this, this is the stock table used to find the closing price for ABC Technologies. And so some things that they're going to ask you is they may ask you, okay, what was the closing price for the day? Now, in all of these questions, we should just be identifying a number. The closing price is actually right up here under the word close, right? See if I can get in there and circle that. It's that guy right there. That's the closing price. And so they're just asking us to name that. Essentially, they just want to make sure that we can read that chart. And so we go in here and we list that the closing price is $54.33. So the opening price, it's not actually giving us the opening price, but it does tell us that it changed by positive $1.02. So we could find the opening price just by subtracting $1.02 from the 54.33. It may ask us for the dividends that this company's paying. The dividends this company's paying is $2.85 per share. So if I had 100 shares, I'd get a $285 by having this stock, right? So it's a nice high dividend amount. So again, where am I getting that? Right here with the dividend amount being $2.85. So just reading from the stock table. Other things I watched them ask for was a volume. And so sometimes I'll have students that mistype in the volume. And you think, well, how could they do that? It's just sitting right there in front of them. So the volume is the amount of stocks that traded that day for this company. So how many stocks were bought and sold that day? This one right here, the volume. Let's see if it lets me write on that again. Maybe it won't. It did before, but sorry, it's not right now. So the volume is 5,915 hundreds. And so what's the volume? 591500. So 5,091,500 stock trades were made that day with this stock alone. So it's huge, right? If you look at the volume for the market, it's super huge, right? Considering every stock that was bought and sold. And this is just in one day, mind you. They might also ask you for the PE ratio. The PE ratio is the price per earnings ratio, the price of the stock for how much that money that company is bringing in, and it's 17. um, the higher the PE ratio, the higher the value of the stock is compared to its earnings. And sometimes that scares people that the stock price is too high. You can see right now that there's a very high PE ratio in the current stock market. And some people worry about that. Others say that that's healthy. So it's hard to know what to know and believe. But you don't have to have a perfect understanding of PE ratios to be successful in this section. We just want you to be able to read information from a chart. The next set of questions covering example 2, which covers, I didn't write it on there for some reason, it covers problems 13 through 16. So 13 through 16 is this one right here. And so let's look at the question. Find the basic cost per share, ignoring broker fees, for 300 shares of Surge Corp. So we're going to look for Surge Corp, and so they're going to give us a table that has a bunch of numbers in it. And we can see Surge Corp down there as the third company listed. It opened the day at $99.25. It had a high during the day of 107, so it went up to as high as 107. Its low was 95.39, and it closed at 102.51, so it closed higher. What was the change from beginning the opening to the end? 102.51 is $2.53. Now what they're asking for is find the basic cost per share, ignoring broker fees, for $300 of shares at Surge Corp at the day's closing price. So we need to buy 300 shares, and each share is going to cost us the closing price, which looks like it's 102.51. So how much are we going to pay for this stock if we buy 300 shares? We're going to pay a whopping $30,753 at the close of the day. So that's it. That's what you do. Now, there are other questions in the 13 through 16 where they talk about broker fees. You would just add those on. They give you another table of broker fees. So if they charge me per trade and I buy all these in one trade, then I'd have to add that on as that price. But I think that will be pretty straightforward. So what I'm hoping you see is that a lot of this is very nice. The next example is one like this example number 3 that I have for you. This will model both 17 and 18 in the homework. It says, for the following stock investment, find the total purchase price, the total dividend amount, the capital gain or loss, the total return, and the percentage of return. So let's see. Let's answer them one by one. Let's look at the total price. The total price would be what we paid for the shares. We had 40 shares and we paid $20 for each one of those shares. So we spent $800 in order to buy the stock. B, find the total dividend amount. So the dividend that we earned on the stock was $2 per share. So again, we had 40 shares and we earned $2 per share, so we're going to earn $80. And then the capital gain. Now remember what the capital gain was. That's just what the stock earned. It's not the dividend. There were two different things. Capital gains, which was how much did you make on the stock? Well, what we sold the stock for was $44. So we had 40 shares, we bought them at 20, and then we sold them for a great price of 44. We did wonderful. Bought them low, sold them high. Well, we don't actually care about that. That's not our true capital gains. That's how much money we take in. So it's bad for me to put an equal sign in there. That's not what I earned. I did have to pay already $800 for those shares. So I'm getting $44 per share. But that's not all profit, which is what capital gains is representing. Capital gains is the profit earned. So I'm going to take what I just got by selling them and subtract away the 800, and when I put that into the calculator, I find that I earned $960 on the stock by just selling it. So it's interesting though, because that's not the total return. The total return on investment would be the capital gain plus the dividend, or the 960 plus the 80, for a total amount of 1,040. We made 1,040 by having this stock because we got a dividend for having it, and we sold it for way higher than what we bought it for. So let's see what our percentage return is. So what's our percentage return? So percent return is simple. It's the amount of the return, what they call the total return. So let me write total in there, divided by what you bought it for. Right? Or what the initial price was, the initial value of the stock. So the total return was 1,040 when I made an $800 investment. That comes out to be 1.3, which means I made 130% by having that stock. We wish we bought way more than 40, right? If we could afford to and buy a ton more, we would have made a killing at 130%. We got all of our money back plus 30%. So it is awesome in that regard. So 130% is what we earned on that. That's our total investment. Okay, let's look at this next one. What is the total return earned by a bond with a face value of 2,000 and annual interest rate? So I put this one on here. This one is towards the end. This is 19 and 20. And this is very nice. Bonds are simple. Bonds pay simple interest. So the interest earned would be the principal times the rate times the time. And that's the return. That's the bond return. The principal, we bought a bond with a face value of 2,000. It's earning 2.5%, which we're going to remember to write as a decimal, and then over 7 years. And when we run that number, we get $350. So we made $350. That's our return. So our return on investment is $350. So it's just a nice simple interest formula. And then we have a couple more problems as we get into the late ones. So there's a lot of problems in here only because they're quick answered in many cases, as you've seen. So let's see this next one. That's going to be like examples 20, 21, and 22 in the homework. The information below applies to the day of investment to a mutual fund. Find the net asset value and the number of shares purchased. Okay, so if we're going to find the net asset value, which they term in the book NAV, is the net asset value. They have a formula. It is A minus L divided by N, where A is equal to the total fund assets. That's where it gets its A from. L is the total fund liabilities. And N is the number of outstanding shares. Right? That's going to give us basically a value per share. So the net asset value for us, the NAV, is equal to A. Now A was not the amount invested. That's later. A is the total funds asset. Total fund assets. And so that's 891 million. And we're going to subtract from that the liabilities, 24 million, and divide by 40. Now everything's in millions, so it's pointless for me to put it in the millions or to write out a bunch of zeros. We're going to get everything truncating down very nicely. And it does go on a little bit, but we have to round to the nearest cent, and we get 2168. That's the net asset value per share. So when they want to know how many shares were purchased, the number of shares purchased, well, we spent 2,900, where the value of each share was 2168 per share. So if we want to find out how many shares we have, we just need to take the 2,900, what we put into it, and divide by the 2168, the cost per share. And it comes to 133.7, and it just keeps going. We can't buy a fraction of a share, so they'll always have us round to the nearest. So we bought about 134 shares, or that's the number of shares purchased when we dropped in 2,900. So that's what's going to happen in a mutual fund, because there's no set price um, in general. So they're going to look at the fund value and the amount you're willing to put in right now, and then they'll determine the number of shares. I do believe in a mutual fund, though, they can go to fractions of a share, but in this case they wanted us to round to the nearest whole share. So the last example, which will cover the last few problems, is also pretty straightforward. Um, I think that they're all kind of nice in their own way, because they have formulas that help us go through it. I think where it came into our critical thinking abilities was the um, the number of shares that we bought, and then also determining the percent return that we had. We had to do a little bit of thinking that was kind of our prerequisites coming in. Example 6. For the following investment, assume that there is no opportunity for reinvestment of funds. Find the monthly return, the annual return, and the annual percentage return. So we're going to invest $775, and the monthly percentage return is 1.2. So then the monthly return is simply this, the amount of money that's in there, and we're going to make 1.2%. And so we just multiply those together, and we get $9.30 for that first month. Well, then the annual return would simply be the monthly return times the 12 months that are in a year. So we're going to make $111.60 annually. Okay. And so now they want the percentage return, right? And not the annual percentage return. So the annual percentage return, just like it was before, it's the amount you made in the time period. It was $111.60 because they wanted it in annual. We already know the monthly. The annual return, and it was a $775 investment. Well, we get 14.4% coming out of that. 0.144. Apologize, maybe I should have mentioned that. What comes out directly in your calculator is 0.144, which translates to 14.4%. So that's a really good percentage to make 14% on an investment, way better than a bond would ever do. But I want you to notice something. I didn't have to do this. We knew every month we were going to make 1.2% times 12 months. If you run that in your calculator, you're going to get 14.4%. Of course you are. That could have been another way. So if you're wondering, why didn't you just take the monthly percent times 12? Well, there's no reason not to have, right? That would have been actually a better way. The two should agree with one another, and they do. So just to validate and value that position. So this is what it's going to feel like in 13.5. I'll get a test review out to you soon. Thanks so much for your diligent work in this section.